Alright everyone, Cowboy Trades here. Welcome back to the channel for another update on the markets. So, the markets are currently disregarding global net liquidity. This is going to be the topic of today's video. Throughout 2023, we've seen a rally in both Bitcoin and equity market prices, despite the fact that we are currently witnessing an exponential contraction in global net liquidity. Now, I'm going to discuss in this video what is currently happening with a deep dive into global net liquidity. We're going to look at a ton of new economic data which we have not previously discussed on this channel. We're going to start from the beginning, look at very simple things, lay some groundwork and what is happening with the interest rates, why we are seeing a contraction in global net liquidity. Then we're going to dive into some more complex topics, some more complex charts and new economic data that I have plucked from Bloomberg. So let's dive right into the video. Let's start by laying some groundwork in why we've been seeing this contraction in global net liquidity since 2022. Well, it's no surprise to see when we look at the contraction in global net liquidity, which really started to take place in February of 2022. This correlates directly to the first set of hikes which happened in the US interest rates from February of 2022, where the interest rates went from 0.25% all the way up to 5.25%, the highest since the 2008 financial crisis, and also just underneath the 2000 financial crisis, in which these interest rates were dramatically increased to the upside. Now, if we come over to this chart here, you can also see a comparison. As soon as the interest rates started to hike, then the global net liquidity started to come to the downside, and the interest rates were being hiked because inflation was getting out of hand. It came all the way up to 9% in June of 2022. Now, we have been seeing a decrease in the CPI year over year from 9% all the way down to 3%. However, I am of the opinion that we are going to see CPI year over year start to come back up to the upside as soon as the next CPI report, with higher CPI year over year creeping back into the economy. I think that's going to pressure the Fed to raise interest rates even further. And you can clearly see here with the inverse correlation between global net liquidity and the US interest rates that this will further cause a contraction in global net liquidity. You can see here where the interest rates are very low. This provides expansionary territory for the global net liquidity. Once they start to get hiked, this is very, very bearish for global net liquidity. Now, to summarize very quickly on why I think we're going to see CPI year over year start to come back up to the upside as soon as the next data point, and why I personally think that by the end of the year at December 2023, we are going to see CPI year over year back up at 6%. Well, here's why. If we come over to the CPI index, this is the index in which the year over year CPI is calculated. You simply look back 1 year and you measure the rate of change on the CPI index. Over here, you can see this is 3% inflation. This is why over on the year over year CPI, we are seeing 3% inflation right now, dropping down from 9%. So why has this been dropping down, and why do I think this is going to be coming back up to the upside? Well, first of all, once again, we measure the rate of change in CPI from looking at the data points from 12 months ago and comparing them from today. Well, if we measure from 12 months ago, you can see this is 3%. Let's take it back another data point. You can see this is 4%. If we take it back another data point, you can see this is 5%. What I'm really highlighting here is the comparison between this exponential run up in the CPI and this not so exponential but still dramatic increase that we are seeing in the CPI. So the reason why year over year CPI is coming down is because we're no longer measuring the rate of change from this massive parabola to the upside. However, here's where things get interesting. For the next 6 months, you can see where we are right now in June of 2023, measuring from the rate of change in June of 2022. For the next 6 months, the CPI index remained absolutely flat, meaning for the next 6 months, we're no longer going to be measuring the rate of change from inflation from this massive parabola. We're going to be measuring from a relatively steady line. And I don't know if you keep up with month over month changes in CPI. Most people just look at CPI year over year, but every single month throughout 2023, we've been seeing an increase in CPI, meaning that, CPI is absolutely not decreasing right now. It's only the year over year which has been decreasing. And if we do just extrapolate the current rate of inflation that we are seeing throughout 2023, this will actually lead us up to an estimate, my estimate, of a 6% inflation by December of 2023. So once again, I think we're going to start to see CPI year over year start to snap back up to the upside to round about a very conservative estimate of 6% by December of 2023. And because of this, I think the Fed will be pressured to raise the interest rates further, which will further cripple global net liquidity. Now, you don't necessarily have to worry about this by the next FOMC meeting, which is going to be in about 5 or 6 days, depending on when I upload this video, because of course, in the last CPI meeting that we've just had, year over year just came down. But following the next CPI report, I think CPI is going to start to come back up to the upside, meaning in the next FOMC on the 20th of September 2023, I think it's a given that the Fed are going to start having to increase the interest rates once again. Now we've covered the groundwork, let's take a deeper dive into global net liquidity instead of just looking at a very simple amalgamation of global net liquidity. Now let's come over to our first chart. This chart over here shows us the US government deficits. Now since 2019, the US government has been abusing low interest short-term debt in the bond market as a means to finance this massive deficit which has been taking place since round about 2019. Over here in 2020, you can see that the US government spending dramatically outpaced its income from taxes, and this is why we saw an all-time high in terms of the budget deficit in 2020, and why this has pretty much been at all-time highs ever since. So who's been lending to the US government? Well, some local investors in the US, but predominantly the US gets its funding from foreign investments. And in particular, the US government attracts these foreign investments through its sales of government bonds in the bond market. Now, because of the fact that the US government has found itself in the largest government deficit it's in, this has caused lenders in the fixed income market, also known as the bond market, to pull the rug and start to demand much higher yields for their bonds. As you can see, if we look at the US government bonds, look at the 2-year yields, the price of this has been dropping to the downside as lenders have pulled the plug, and because of this we've seen an increase in the yield. If you didn't know, the prices of government bonds are inverse to the yield, and that's basically because the lower the agreed purchase price for a bond, the greater the APR or yield. For example, if the US government asks you to invest $100 and they'll pay you back $200 in 2 years with one of their government bonds, that's a 100% increase or a 100% yield. Now let's say the price of that bond falls to $50, but they're still going to pay you back $200. You can imagine the yield of that is going up because you've purchased that bond for a lower agreed purchase price. This is why you see the price of bonds inverse to the yield. Now, while new lenders have thrived in this new market equilibrium, if we come over to the interest rates, once again, if you're a lender right now lending for 5.25% or anywhere near there, you're very happy. However, borrowers, not so much, and old lenders, not so much either. For example, if we come over to Silicon Valley Bank, basically they loaded up on a bunch of US government bonds expecting the rates to remain flat. What happened? Well, the price of the government bonds fell through the floorboards, increasing the yields, and basically Silicon Valley Bank and a bunch of other banks' bonds became absolutely worthless, and this is where we saw the systematic failure in banks quite recently. Now, since the failure of SVB and a bunch of other banks, the Fed decided the best course of action was to inject some small liquidity into their treasury cash balance sheet for banks to use as a means of last resort. If we come over to the US Treasury cash balance, Federal Reserve account, that is a mouthful. A chart over on Bloomberg, you can see, round about 2023, when SVB happened, we saw that dramatic increase in the Treasury cash balance. If we come over to federalreserve.gov and come over to their balance sheet developments, if we scroll down, you can see in their most recent report, you can see there has been an increase in other assets. This is predominantly in the form of their liquidity and credit facilities for banks, providing them with a little bit of liquidity in case something like SVB happens again. However, this is not liquidity for us. This is liquidity only available for banks. This is why you're seeing this not really take a dramatic effect in global net liquidity whatsoever. And additionally, this is also not quantitative easing. If we come over to the total Fed balance sheet, not just looking at their treasury cash balance sheet, you can see this was the spike in which liquidity was provided following March when the SVB crisis happened. As you can see, since the end of 2022, we have been seeing quantitative tightening take place, and despite the fact there was some liquidity that was made present for some banks like SVB, quantitative tightening has already dissipated from this small liquidity that went into the treasury cash balance sheet. If we do come over to the Fed balance sheet, you can see, throughout 2019, 2020, this was when quantitative easing was running into the markets. Since then, we've been seeing quantitative tightening. This is a zoom in on what happened at the end of 2022. Once again, this little spike that we saw was not quantitative easing, and it has already been eaten up by the quantitative tightening cycle, which is happening right now. We are seeing new all-time lows for this bear market in terms of the total Fed balance sheet, despite the fact that their treasury cash balance sheet has increased slightly, but bear in mind we are still in a substantial downtrend since 2021. With less than a third of the assets in the US Treasury cash balance sheet as opposed to the start of 2021. If we come over to another broader metric for liquidity, look at the M2 money supply, this shows us that for the first time since 2008, the money supply is actually seeing a significant correction, down about 5% since its peak in 2022. The Fed's quantitative tightening cycle that we're seeing right now can also be identified by looking at the Fed's liabilities. Once again, remember the definition of quantitative tightening is where the Fed sell their securities into the open market. And right now you can see if we are looking at the Fed liabilities, they are selling everything from reserve balances, other deposits with the Fed, reverse repos. The only thing that they're not selling right now is currencies. And once again, this can be predominantly associated to the fact that we are still seeing the Fed hold cash on the sidelines in their treasury accounts in the case that another bank run happens. We can also see the effects of quantitative tightening take place when we are looking at the Fed's assets. They are currently selling everything right now from treasury securities, treasury bills, agency debt, mortgage-backed securities, also known as MBSs, and other assets they do hold on their Fed balance sheet. So because of everything we just talked about, which is contributing to the fact that global net liquidity is coming to the downside, such as the interest rates being hiked, the yield of the government bonds being pushed to the upside because of the fact that foreign investors have pulled the plug on supplying the US government with money by purchasing their bonds, because of the fact we are seeing the largest budget deficit right now in the US recorded in history, because of these widespread banking failures which are causing for liquidity to be sucked out of the ecosystem right now. How is this affecting the other side of the market in terms of the consumers? We've looked at this predominantly from a banking perspective, from a Fed perspective. What about the consumer perspective? Well, when the interest rates are hiked, when we're seeing all of these effects take place, sucking out global net liquidity, what does this do for credit and consumers? Well, it increases the delinquency rate. Because banks are tightening their standards for credit right now, you can see this in the net percentage of domestic banks tightening standards for credit. You can basically see when this line comes to the upside, banks are tightening who they are willing to give credit to. And as you can see over here, this normally comes hand in hand with an increase in the delinquency rate. The delinquency rate is basically the rate at which people are becoming delinquent or not paying back credit card loans, commercial loans, etc. Now, on both of these charts, what I've highlighted with this indicator over on TradingView, the US recessions indicator, I've highlighted in different instances where the US has entered recessions. Now, what typically happens if we come over to the United States interest rate, you can see as the Fed starts to tighten the interest rates, this cripples global net liquidity. What then happens is after the Fed increases the interest rates, we see banks tightening their standards for credit. And after you see banks tighten their standards for credit, what happens is consumers become delinquent. They're no longer able to pay back their lines of credit. And this is typically where you see the apex of banks tightening standards and you witness a recession take place soon after. Put quite simply, we've never seen banks tighten at a pace like this, and we have not seen a recession. So this is one of the reasons why I am currently predicting a recession. We have talked about this previously on the channel, so I won't dive too deep into this. If you have watched my previous videos, you know I've detailed things like Bloomberg estimates for real GDP. The 2024 forecast is down at 0.7%. We only need 2 successive data points for nominal GDP beneath 0%, and boom, we're in a recession. And Bloomberg analysis are currently predicting a 65% median chance of a recession to come for the US in 2024. Now, to top things off, like I've previously been saying on my channel, I do believe that foreign investors are going to be more hesitant to purchase government bonds at this moment in time. I think the US has really had a rug pull in terms of foreign investors that want to invest in the US right now. This has pushed down the price for government bonds, pushed up the yield for government bonds, and I think this is going to continue to happen. Now, if we come over to the yield curve, this is basically the US 10-year government bonds minus the 2-year government bonds. This reflects bond market sentiment. We're basically at all-time lows for the yield curve right now. So the bond market is also in agreement with myself that we are going to continue to see yields push back up to the upside. And the reason why, the price of yields are pushing down right now is because investors are probably sitting on the sidelines like myself, potentially thinking yields are going to push up further, maybe to 5%, maybe to 6%, maybe to 7%. And at that point, it may be more attractive to purchase government bonds, pushing the price up and then pushing the yield down, meaning you could have locked in maybe a 5, 6 or 7% yield at the perfect time. This is currently something that I'm looking at this moment in time. Maybe I'll talk more about that in a different video, but the yield curve, basically the bond market is in agreement with myself in terms of the US government bond yields increasing to the upside. And in terms of the interest rates, if we come over to Fed futures, they are currently at 5.4%. New all-time highs, meaning that in terms of the futures market, we are currently expecting the interest rates to have at least one further interest rate hike in the immediate short term. And like I previously discussed with my analysis, looking at the CPI index, I really think CPI is going to start coming back. I think because CPI year over year is going to start to come back, this is going to pressure the Fed to further raise the interest rates. This is going to cripple global net liquidity. Because this is crippling global net liquidity, banks are going to tighten their standards for credit. Because banks are tightening their standards for credit, it's going to be very hard to borrow money. People are going to become delinquent on the loans which they have got. And as you can see, it's very clear to see here with both of these charts, when you see banks tightening their standards for credit, and subsequently as you see the delinquency rate take a run to the upside as a result of this, recessions always follow. So to tie everything up, because of all of this, I think we're going to see real GDP take a real plunge to the downside, and that could put the US in recession territory, and then this cycle could get exponentially worse. Because of this, global net liquidity could really see a crippling throughout 2023 and potentially into 2024, and this will have a negative impact on the prices of cryptocurrencies in the stock market. I know most people who watch my videos are more interested in the cryptocurrency markets than the stock market. I will just leave you with this one chart zoomed out to show you the effects of global net liquidity in Bitcoin. As you can clearly see, when global net liquidity comes down, this is very bearish for Bitcoin. When global net liquidity comes up, this is very bullish for Bitcoin. We're very close to making new all-time lows for global net liquidity, and as we do see the CPI come up, which will probably cause the Fed to raise the interest rates, this will have a crippling effect on global net liquidity and the prices of assets throughout 2023 and maybe into 2024. So for today, my friends, that's all I've got. Hope you did enjoy the video. Definitely more of an in-depth one, but I do enjoy amalgamating all of these data and going through some of these, new charts and discussing new topics with you. Let me know if you like that in the comment section down below. If you do enjoy the videos, as always, you know what to do. Leave a like and a comment, share the videos with your friends. If you want to further support the channel, feel free to click the join button on YouTube and become a member today. Follow me over on Twitter at 618_cowboy. It's been your boy Cowboy Trades. I'm out. Peace.